previous videos, we discussed how distribution days appear when the index falls on higher volume. So these yellow arrows, they show the distribution days, and they usually tell us that institutions are selling and there is a pressure in the market, and often this happens before the headlines turn negative. You can see my previous video for more details. Now let's talk about the opposite scenario, how to identify that market is probably nearing its bottom and it's likely to rise up from here. So it never happens that the market falls in a straight line, it keeps on going down. There are often rallies which come. But how do we define a rally? So it doesn't mean that any time the market starts rising up on any particular day, it doesn't mean that we this is the right time to start investing. Most rallies fail. So what is a meaningful rally day? It is basically the first few days when the market actually rises up from a bottom after several down sessions. So, for example, when the market rolled in September 2024, we saw the first rally on 18th October. This green candle over here. So, market had made a significant bottom and there was a green candle. But again, this doesn't mean that market started rising up after that. It was a failed rally. Market kept going down until it made another rally on 5th November. We saw the next rally on 5th November, which also did not carry, and the market kept going down. We saw just a brief rise in the market. Like I said, it's never a straight line down or up. So, we saw several rallies. Like again, we saw on 17th Jan, then 20th Jan, but none of these were good enough to confirm that now the market is likely to move up. So, how do we confirm that this rally is actually the right one and this rally is not the right one? So, for this, William O'Neill has very smartly given another framework. So, after a rally day, we must see a follow through day. This is a very important condition. It occurs between the next 4 to 7 days after the rally has occurred. So, let's see, for example, on 11th March, again we saw a rally. This was followed by a follow through day finally on 18th March. This green candle over here. So, what is a follow through day? It comes between after the rally day, it should happen between next 4 to 7 days, and it should be like a bang in the market. Suddenly, the market should rise enough, more than 1.5%, and the volume should be higher. You can see here the volume on this day was higher than the previous day and significantly higher, and market was also, you can see this green candle is way above the earlier trading zone that the market was trading in. So this was called as the follow through day, after which we saw a brief movement upwards until Operation Sindoor happened. Again, follow through day doesn't mean that we should jump in and start putting all our money in the market. It means that this is probably the start of a new uptrend. However, and institutions are returning to buy, but we should start investing slowly and see that whether this follow through carries, and not definitely not invest all our money in one go. So in this case also we can see that the follow through day came in March, but again the distribution day started piling up very soon, and finally on 8th May we had 5 distribution days and the market rolled. So again here we had seen Operation Sindoor. So we need to keep checking the trend every day. It doesn't mean that the follow through day has come, so now we can close our eyes and just blindly invest all the money. This checking has to be done every day for it to make any meaningful sense. You never know, from the next day of follow through day we can start getting distribution days once again. In the next video, we will discuss what is the time duration for which an investment should be made. Should we invest long term or should we invest short term?